Welcome, deep divers. Imagine a cornerstone economic idea, right? One has been pretty fundamental in how we understand companies behave, a basic, almost intuitive principle about whether it's, easier for a company to build things up, like expand a factory or tear them down, sell off machinery,
Mm-hmm.
a core concept.
Exactly. Now, picture that long-held truth being publicly challenged almost audaciously in a really big academic journal. Sends ripples through the field, right?
Yeah,
Questions decades of thinking.
yeah, that would definitely turn some heads.
But the story doesn't stop there. A new team of researchers steps in, pulls back the curtain on that initial challenge, and through some serious data detective work, they uncover this, well, fascinating tale of discovery and maybe restoration.
It really is like an academic thriller plot sometimes.
It is. So today we're taking a deep dive into exactly this kind of story. We're exploring the pretty intricate world of firm-level investment behavior, focusing sharp on this key concept, costly reversibility.
Sounds a bit jargony, maybe? It does, but stick with us, because it has huge, real-world implications.
Mm-hmm.
It basically asks whether companies face significantly higher costs or more difficulty when they decide to reduce their assets, selling off a division, closing a factory, getting rid of specialized equipment, compared to when they expand those same assets.
Right. Is it easier to build than to unbuild?
Precisely.
Yeah.
At the heart of it is this really profound question, impacting everything from stock prices to economic policy.
Mm.
Do U.S. public firms genuinely find it harder, more expensive to cut their capital than to grow it?
Or are they maybe surprisingly nimble, like that recent research claimed, able to shed assets easily?
Yeah, are they flexible chameleons, or are their investments more like, I don't know, concrete foundations, hard to rip out?
Analogy.
So to unravel this, we're digging into a recent, very impactful research paper. It's called Firm-Level Irreversibility by Hang Bai, Erica Lee, Chen Sui, and Lu Zhang.
And this paper isn't just presenting new stuff, it's doing something crucial.
Exactly. It meticulously re-examines, reproduces, and replicates the findings of a widely cited earlier study by Clementi and Palazzo CP that had claimed to overturn all this established thinking.
So it's a direct response, a reevaluation.
Our mission today,
Right.
navigate this academic detective story. We'll uncover the key data points, the subtle, sometimes hidden methodological choices, and the big picture implications for how we understand corporate investment. It's going to be fascinating.
It really is. And, for anyone trying to understand market dynamics, the stakes here are actually pretty high, both theoretically and practically.
That's a great point. Okay, let's unpack this costly reversibility idea. You said it sounds academic, but for our listeners, maybe you're an investor, a business owner, just tracking the economy, it really matters for how companies grow and sometimes shrink. What's the basic insight here, the one that guided thinking for so long?
Well, at its core, costly reversibility suggests it's disproportionately more expensive or just harder for a firm to undo an investment sell-off capital than to make it initially.
Real.
Think about a company expanding production. They buy new gear, build a new factory wing, maybe a whole new plant. The theory says if later market conditions tank, demand drops, and they don't need that capacity anymore,
Right.
the cost of scaling back, selling specialized machines that nobody else wants, dismantling the building, breaking supply contracts, those costs are way higher than the initial expansion costs.
Oh, okay. It's stickier on the way down.
Exactly. Sticky, it's not a new idea either. Economists have built models around this for decades. It draws from things like real options theory.
Which is like the value of waiting or changing your mind on a big project.
Precisely. The value of flexibility, the cost of committing to something irreversible. And it connects to the neoclassical two theory of investment, which basically links investment to a company's market value versus its replacement costs. So these theories, especially with costly reversibility baked in, predict firms will be cautious. They hesitate before big investments because they're sticky decisions. And once they do invest, they're much less likely to do big negative investments, big cuts, because it's just too expensive.
So for you listening, this means companies aren't just smoothly turning a dial up or down on their assets. They make big, hard-to-reverse decisions. Once they build, it's really tough, really costly to unbuild. That's key for understanding resilience, or maybe how slow they adapt to downturns, right?
Absolutely crucial insight. Makes intuitive sense, too.
Yeah, it does. But where did economists first see this playing out in the real world? Where did it get its empirical teeth beyond just the theory?
Good question. Theory needs data. And the initial really solid empirical evidence came from super detailed studies, not at the whole firm level, but at the plant level.
Right.
individual factories.
Oh, okay. More granular.
Much more. A landmark study was by Cooper and Haltwenger in 2006. They looked at, get this, 7,000 large U.S. manufacturing plants over almost 20 years using incredibly detailed data.
Wow, that's a lot of plants.
It is, and their findings painted a really clear picture. They found what they called a heavily right-skewed investment rate distribution.
Okay, right skewed. Break that down for us visually.
Imagine a bar graph showing how often plants invest at different rates. Most of the bars, the activity, cluster around 0 or slightly positive. But right skewed means there's this long, stretched out fat tail going way out to the right, representing those occasional huge bursts of investment, big expansions, lumpy investments.
Got it. And the other side, negative investment.
That's the key. The tail on the left for negative investment, divestment, was much shorter, much thinner, closer to 0.
So big buildups happen, big teardowns, not so much.
Exactly. Cooper and Haltwenger found only about 10.4% of investment rates were negative, below -1%, but a whopping 81.5% were positive, above 1%.
Huge difference.
Massive. They called this striking asymmetry a key feature the data demanded, and they directly linked it to costly reversibility. It's the picture. Plants sometimes make big, lumpy investments, but they rarely make equally large disinvestments.
They called it the smoking gun, right, for costly reversibility.
That's the term they used, the smoking gun.
Okay, so here's where it gets really interesting, because that strong plant-level evidence, that clear asymmetry, was challenged. A more recent paper seemed to just flip it on its head. This isn't just academic quibbling. It implies a totally different kind of company, right? Affects valuations, expectations. What did this new research claim?
Exactly. This is the plot twist. In 2019, Clementi and Palazzo CP published this paper in a top finance journal, a very prestigious place, and they claimed they overturned Cooper and Haltwenger's conclusion.
How different data.
Yes. Crucially, they looked at the firm level using Compustat data for publicly traded U.S. firms. They argued maybe big public firms behave differently than individual plants. They even said their work was akin to Cooper and Haltwenger's, but they found the opposite.
The opposite. So what did their graph look like?
They described it as largely symmetric. Instead of that lopsided right-skewed picture, theirs was balanced. And instead of a small fraction of negative investment, they reported a huge chunk. 18.2% of firm quarters showed capital reduction.
18.2%. That's way higher than 10.4 or less if you consider the firm level might smooth things out.
Way higher. Their conclusion was blunt. No sign of irreversibility. Firms have ample latitude to divest. They said plenty of firms downsize at all times, and the whole irreversibility idea has no empirical support for public firms.
Wow. That's a massive claim. If true, it changes everything about how we think these big firms operate.
Monumental shift, if true. It implies these firms are way more agile on the downside than anyone thought. Contradicts decades of theory and prior evidence.
So picture those two graphs again. Cooper and Haltwenger's lopsided one for plants, little negative investment. CP's balanced graph for firms, lots of negative investment. CP basically said the balanced graph is the reality for big companies, super bold. If that held up, what would it mean? Why would firms be so different from plants?
Well, it would suggest that big public firms, maybe because they're more diversified, have better access to markets to sell assets. They just have a flexibility that individual plants don't. It would challenge how we model investment, value firms, think about recessions. I mean, if firms can divest easily, maybe downturns aren't as sticky.
Yeah, huge implications. So with such a direct contradiction, someone had to take a closer look, right? Enter Bai et al. What was their approach? How did they scrutinize CP's bombshell findings? Seems like a necessary check.
Absolutely necessary. The academic world relies on robustness. When a study challenges such a core idea, scrutiny is vital. Bai et al. Took a really systematic approach. Reproduction, replication, and reanalysis.
Okay, those sound similar, but you said they're distinct.
Very distinct in research. Reproduction is step one. Take the original author's exact data, exact code, follow their exact steps. Can you get the same results? It's a basic quality control check, like, does the recipe actually make the cake they described?
Okay, basic check.
Then replication. Use a different sample, maybe slightly different time period, or a slightly different but similar method. Do the findings still hold up? Does the recipe work with slightly different ingredients or in a different kitchen? Test the generality.
Makes sense. Broader conditions.
And reanalysis. This goes deeper. You materially change the model, use new data, attack the core claim from a different angle. Does the underlying idea still hold water? It's like, can we make a better cake that still tastes like the original concept, maybe using a totally different recipe?
Got it. Reproduction, replication, reanalysis.
Oh.
A thorough audit. So what did Bai et al. Find after putting CP's work through this wringer?
Well, their conclusion was pretty stark. They found CP's evidence claiming no sign of irreversibility was, quote, flawed. They identified 3 design problems and at least 5 discrepancies in reporting, coding, and data. Basically, a whole list of issues.
Whoa.
And these issues, they argued, led CP to paint a misleading picture of how reversible investments really are for public firms. It was a deep, meticulous audit.
Okay, that's a lot of alleged flaws. Let's dig into them. Where did they start? You mentioned fundamental data error, something right at the beginning.
Indeed. The first major issue they flagged was about how CP measured gross investment itself, specifically a mix-up with depreciation rates.
Depreciation. Okay, how does that work?
It's a bit technical, but crucial. CP used net property, plant, and equipment, net PPE, from CompuStat. That's assets after deducting wear and tear, right?
Right, net value.
And they correctly noted that accounting depreciation is sort of embedded in that net PPE figure. But here's the slip-up. When they calculated gross investment, total new investment before depreciation, they added back depreciation, but they didn't use the accounting depreciation consistent with their net PPE measure.
What did they use instead?
They used geometric depreciation rates from the U.S. Bureau of Economic Analysis, BEA. Think of BEA rates as standardized industry average rates. They're often lower and smoother than a specific firm's accounting depreciation, which reflects its actual asset use.
Okay, so they mixed 2 different kinds of depreciation, like apples and oranges.
Exactly like apples and oranges. Imagine your car's odometer tracks mileage after accounting for its specific wear and tear, accounting depreciation. If you then tried to calculate the total miles driven, gross investment, but added back a government estimate of average car wear and tear, and that average was lower than your car's actual wear.
You'd underestimate the total miles driven.
Precisely. CP mixed firm-specific net data with lower, smoother, industry average BEA depreciation. Because these BEA rates were generally lower and more symmetric than the often higher right-skewed accounting rates, CP systematically underestimated gross investment.
Okay, and what did that underestimation do to their results?
2 big things. First, it shifted the whole gross investment rate distribution leftward. Adding back less depreciation made it look like firms were divesting more than they were. It artificially pumped up that negative investment fraction from a corrected 6.08% to CP's reported 18.2%. Created an illusion of downsizing.
Wow, just from that choice.
And second, by adding back the smoother, symmetric BEA rates instead of the spikier, right-skewed accounting rates, they also curbed the right tail. It flattened out those big positive investment spikes. BIAID showed fixing just this one error dramatically increased the skewness measure from CP's implicit 2.18 to 3.37. It hid the asymmetry.
That's huge.
Yeah.
A fundamental measurement error changing the whole shape of the story.
Yeah.
Okay, so the depreciation mix-up was clue number 1. What about these non-standard sample screens Bai et al. Mentioned? Sounds like filters CP used.
That's right. These weren't just typical data cleaning steps. Bai et al. Argued these filters systematically remove data that's actually crucial for seeing the full picture, especially the high-growth, high-investment side.
Like blinders, almost.
Kind of. The first was dropping the first 12 quarters, 3 years for every firm, an age screen. And this was hidden in their code, not really detailed in the paper.
Why does dropping the first 3 years matter?
Well, think about it. Younger public firms in their first few years are often investing like crazy, right? Scaling up, grabbing market share. They have higher growth rates.
Right, high investment period.
By systematically cutting out these early high investment periods for every single firm, this screen automatically curbed the right tail of the distribution, made it look less skewed towards positive investment. Bai et al. Found just removing this screen boosted skewness from CP's 2.29 up to 3.39. It's like studying forest growth, but ignoring all the young, fast-growing trees.
You had a skewed view of growth, ironically. Okay, what was the other screen?
The other was dropping firm quarters linked to acquisitions larger than 5% of total assets, an M&A screen. And 5% quarterly is really strict.
How strict?
Usually in finance research trying to separate internal growth from M&A, the cutoff for annual data is more like 15%. CP used 5% for quarterly data. Acquisitions are often lumpy, happening in one quarter, so 5% is tiny.
And who does large M&A?
Typically growth firms, high investment firms, profitable firms expanding externally. By kicking them out, or the quarters they did deals, this screen also curbed the right tail. Again, dampening the observed skewness, making investment look smoother. Removing the screen pushed skewness up from 2.29 to 3.46.
So both screens disproportionately remove the kind of high investment activity that creates the right skewness they claimed didn't exist.
Precisely, filtering out the evidence they were looking for, in a way.
Okay, so we've got the depreciation error, these non-standard filters chopping off high-growth data. But you mentioned buy it all. Found other issues too, more subtle things. Even after correcting for these, they still couldn't quite get CP's main picture, especially their key graph.
That's right. The plot thickens. Buy it all. Also found several discrepancies between CP's reporting and coding. Things done in the software that weren't clearly explained or explained at all in the paper. Little methodological choices that added up.
Like what?
Okay, there were a few. Lifetime exchange code restrictions. Firms had to be listed on major exchanges, NYSE, Amex, NASDAQ, for their entire life. If they ever got suspended or started smaller, their whole history was tossed. Probably removed more dynamic firms. A redundant capital accumulation recursion. Basically, an unnecessary calculation in their code that accidentally required all historical data, leading them to drop over 14% of their observations for no good reason.
Just gone.
Poof. Then, merging investment with stock returns using a 2-quarter lag. This specific method meant losing data from the very beginning and very end of their sample period.
Okay.
And deflating net PPE using an aggregate price index. While adjusting for inflation is standard, using this broad index again slightly shifted the whole distribution leftward, making negative investment look a tiny bit more common.
So a bunch of smaller things that also subtly pushed the results in a certain direction.
Exactly. But here's the kicker. Buy it all.
Yeah.
Found that even after meticulously correcting for all of these things, the big depreciation error, the non-standard screens, these hidden discrepancies, the right tail of the investment distribution still weakly survived.
It was still there, even after all that.
It was still there, yeah. Weakly, perhaps, but present. Which meant that CP's figure 1, their main histogram, showing that perfectly symmetric distribution, couldn't be fully explained by these issues alone. There had to be something else, something more direct.
The final piece of the puzzle. What was it?
This is where it gets really, really eyebrow-raising. Bai et al., unable to reproduce figure 1 from the paper, did the crucial step. They got CP's original Stata code, the programming script, and buried in the code were explicit commands to truncate the investment rate distribution. They chopped off the right tail at 0.2 or 20% investment rate, and the left tail at -0.2, -20% before plotting the histogram.
Wait, they just cut off the ends. Cut off the high and low
It would
investment.
just cut them off. For the visual, it wasn't mentioned anywhere in the paper.
That's not standard practice, is it?
Bai et al. Called it a questionable research practice. Think about it. You're trying to show the shape of the data, but you remove the extremes, like showing human height distribution, but cutting off everyone really tall or really short.
Your graph would look much more bunched up, more symmetric.
Precisely. And the amount cut off wasn't trivial. That truncated right tail alone contained over 14,800 observations, 4% of their sample, with a huge average investment rate of 36%. These were the massive positive bursts, just visually deleted. The left tail cutoff was smaller, about 1.5% of the sample.
So this truncation is what finally created that symmetric picture.
It fundamentally altered it. It changed CP's unreported skewness from their own data tables, which was 2.18, already positive, down to a weakly negative, -0.08 for the figure they showed. That -0.08, silently communicated by the graph, was the shocking refutation, but it was created by truncation.
Unbelievable. It was an artifact of how they drew the picture.
Largely, yes.
Yeah.
And adding one more wrinkle, Bai et al. Found the sample used for that figure 1 was actually different and 23% larger than the sample used for their main tables, with looser criteria, just more inconsistencies.
What a story. Data errors, weird filters, hidden discrepancies, and finally just cutting off the tails for the main visual. Okay, after Bai et al. Painstakingly corrected everything. Undid the truncation, fixed the depreciation, removed the odd screens. What did the true picture look like? What did the real graph of firm-level investment show?
The moment of truth. After all the corrections, the data consistently, powerfully revealed a heavily asymmetric investment rate distribution with a fat right tail. Just like Cooper and Haltwanger found at the plant level, the consensus was restored.
Okay, give us the numbers. What happened to skewness and negative investment?
Right, skewness. Instead of CP's near zero or negative figure from the truncated graph, it soared. In CP's original setup, corrected, it hit 4.8. Using more robust methods like Winsorizing outliers, it stayed high, between 3.53 and 3.59. Clearly strongly positive skewness, lots of big positive investment.
And the negative investment, that 18% figure.
Plummeted. The fraction of negative investment rates dropped significantly from CP's 18.24% down to a much smaller range, about 4.94% to 6.17%, depending on the exact robust measure used.
So big divestments are actually pretty rare, much rarer than CP suggested.
Much rarer. The corrected graphs show that clear rightward lean. Big positive investments are common and lumpy. Big negative ones are not. As Bai et al. Memorably put it, their work restores the fat right tail of the gross investment rate distribution to all its glory.
The smoking gun was there all along, just buried. Why was that asymmetry, that fat right tail, so important to Cooper and Haltwanger originally, and why does restoring it matter so much now?
Because it directly reflects the economics. Cooper and Haltwanger called it decisive evidence, a key feature. They stressed the distribution as non-normal, highly skewed right, fat tails. This pattern, big positive bursts, little negative investment, is exactly what models with irreversibility and non-convex adjustment costs predict.
Non-convex adjustment costs.
Meaning the cost of adjusting capital isn't smooth or linear. It might be cheap to adjust a little, but very expensive to adjust a lot, especially downwards. Selling specialized factories, breaking contracts, mass layoffs, these have disproportionately high costs compared to just expanding a bit. Okay.
So if capital was easy to adjust up or down, you'd see a more symmetric response to shocks. But if it's costly to shrink, which seems to be the reality, firms hesitate to invest big, and once they do, they hang on to that capital longer, avoiding those big, costly divestments.
The asymmetry is the evidence of the costliness.
Exactly. It's the empirical footprint of those real economic frictions. It shows that basic idea it's harder to cut than to expand is robustly present in how public firms actually behave.
Yeah, so we've followed this amazing data trail, restored this core idea. But what are the ripples? What does knowing costly reversibility is real is squarely in the fabric of our reality, as Bai et al. Say, actually change? For models, for valuations, for understanding the economy, what are the takeaways for you listening?
The implications are really significant. Remember, CP's claim of no irreversibility wasn't just an empirical finding. They built their theoretical models on it. They forced their models to match that incorrect 18.2% negative investment figure.
Uh-oh. Garbage in, garbage out. Exactly. Bai et al. Argue that because CP's models were built on that flawed foundation, their theoretical conclusions, like about investment-based asset pricing models or explanations for the value premium, were mostly wrong. The whole structure was potentially compromised by the faulty base.
Wow.
And Bai et al. Went further than just critique. They did that reanalysis using a baseline investment model and that sophisticated simulated method of moments technique.
Right. Matching model simulations to real data patterns.
Yes. And they estimated the adjustment cost parameters. The results were stunning. The downward adjustment cost cost of cutting capital was estimated at a massive 102.26.
102. Okay, compared to what?
Compared to the upward adjustment cost parameter, the cost of increasing capital, which was estimated at only 114.
0.14 versus over 100.
An enormous difference. Orders of magnitude more costly to shrink than to grow. That's direct quantitative evidence for costly reversibility. And the model they built with these costs did a great job matching real-world data, like the value premium and the corrected low fraction of negative investment.
So the model built on reality actually worked better.
Precisely. It reflects what philosopher of science Michael Weisberg calls minimalist idealization, focusing on the core causal forces. It shows this asymmetry mechanism isn't just theory, it's a robust theorem, Bai et al., say squarely in the fabric of our reality.
And it's used elsewhere in finance.
Widely. Their paper cites 28 other theoretical articles in top journals since 1999 that build on this exact mechanism, applying it to real estate returns, credit spreads, all sorts of puzzles. It's a cornerstone, now reaffirmed. For you, the listener, it means understanding companies likely have less flexibility to shrink than some might think, impacting risk, strategy, everything.
What an incredible deep dive. We started with this idea seemingly turned on its head, went deep into the weeds of data, methods, code, and ended up restoring a fundamental truth about how firms behave. It's more than just academic back and forth, isn't it?
It really is. It underscores just how vital meticulous data work, transparency, and replication are. You can't just accept bold claims, you have to check the foundations. And this asymmetry, driven by costly reversibility, it's not a minor detail. It's a core mechanism shaping investment, asset prices, maybe even the macroeconomy. Getting it right in our models makes them vastly more powerful, more truthful.
And it leaves us with a really interesting thought, doesn't it? If a foundational idea, once challenged like this, can be so powerfully restored just by looking closer at the data, doing that intense detective work, well, what other settled debates or eye-catching claims out there might deserve a similar deep dive into their methods and evidence? How does this change how you critically look at new information, whether it's finance, science, or just the news you read every day? Something to mull over until our next deep dive.